Okay, we're going to get started today. Again, this is Adam Goldstein with the Federal Home Loan Bank of New York. Good morning. Thank you for joining today's webinar presented by our very own Rei Shinozuka, the Director of Capital Markets Research, and Tom Settino, Director of Member Relations. Before we get started with today's session, I want to remind you, or actually give you a preview of our next session, the evolution of payments, a presentation by Bank of New York Mellon on Thursday, May 13th. The webinar is going to cover a lot of topics. We decided to put this one on the roster because one of the many things we've been hearing from our members in the COVID environment has been the importance and the kind of explosion of digital in their businesses. And a lot of people obviously doing business out of their homes, so how digital has impacted the financial services industry and specifically the evolution of payments has been a hot topic. And these are kind of thought leaders in that space. We've received some presentations from them on payments and on this is Adam Goldstein with the Federal Home Loan Bank of New York. Their announcements recently to be custodians for a lot of the cryptocurrency. So having listened in on some of those presentations, we thought that it would be value add to bring them to you. So we added them to our speaker session. Invitations for that session will go out on Monday, and we hope that you'll be able to join. And of course, we're keeping it same day, same time.
And one of them might be the issuer, whomever, and then it also adds that
$36 million in housing grants
in the mortgage markets,
21 affordable housing program.
You could say today,
line for submitting application
markets like they moving on to slide 13. Opinions, these are based on early on. I'll fix that. $800 billion. Fixings are based on transactions, based to get away from using an over. Press was the
also includes
they're in the Fed guide to happen to them, and we break that
phone and
for calculating risk.
All right. Well, thanks, Ray. I appreciate institutions don't have much in the way of floors that we can embed into
your RSA device.
Next SOFR swaps with us. Switching over their custom
50 kind of thing. I mean, we sort of there's a need for
one. Enjoyed the presentation.
Your soft tokens or the importance and timing of this, again, let us know. This is a hot topic with our members. We want to make sure that all channels of distribution for doing business with us are taken care of. And finally, we continue to onboard members in our new mortgage asset program. We've launched that program. We have over 22 members in it right now. Many of them are delivering loans to us. Over 140 million in master commitments so far, so doing quite well. If you were, I should say, an MPF participant, you know we're not offering that program anymore as of the end of the first quarter. There's just a couple of you out there that still need to get converted over to the MAP program, and we encourage you to contact your relationship manager to schedule a one-on-one as soon as possible. So just a couple quick details for today's webinar. If you have any questions, please submit them at any time through the question box, and we'll have a Q&A session at the end. And we're also looking for ways to enhance the program that we offer you. So please complete the survey. Let us know what you want to hear about, and we'll be sure to put it on the roster for you. The topics and speakers we select really come directly from you, with the exception of the payments one that I mentioned earlier. I just thought that would be a great topic for you all. But for the most part, the whole roster is on what you want to hear. And speaking of what you wanted to hear, the great transition from LIBOR to SOFR. One of our most visited sections of our public website are the podcasts. So we wanted to bring back the two stars of that show to talk a little bit about that. And with that, I'll hand it off to Tom and Ray. I think, Tom, you're going to kick us off.
Yes, thanks, Adam. Good morning, everybody, and thank you for joining us today. It's really a pleasure for me to introduce Rei Shinozuka. In addition to being the Director of Capital Markets and Research, Ray also heads the Benchmark and Index Transition Office at the Federal Home Loan Bank of New York. And then Ray and I started pretty much around the same time, around a decade ago. So we just celebrated our 10-year anniversary. So that's a good milestone. And it's a real testament for the Home Loan Bank. It's a great place to work, and we love helping to serve our members and working with the customers. Fantastic. But prior to joining the Federal Home Loan Bank of New York, Ray had been a MBS strategist at UBS, And then before that, he was director of fixed income and quantitative research at Payne Webber and UBS. And then he also developed CMO and mortgage analytics at Morgan Stanley. So he's had a long career in finance, and we're happy to have him for the last 10 years. Rei has also earned his undergraduate and graduate degrees from Columbia University. So I'm really looking forward to this presentation, Rei, and with that, I'm going to turn it over to you.
All right, well, thank you for that kind introduction, and welcome to everyone for being here. Hopefully there'll be a mix of some new stuff, some old stuff, but certainly anything we miss, we will certainly try to get to it in the Q&A section. So again, thank you for being here today. So let me just kick this off. So what we're going to do is just start off with a recap. What's happened, I guess, since the last time we did this about a year ago in the summer. So we'll try to recap what's transpired since then, which has actually been quite a bit, and some of it just in the last week. I mean, I had to revise this a couple times just to get in the latest news that would come in the morning. But that's it's all good stuff. And then I'll follow on the section on the market growth development of SOFR from 2018 to 2021. And then we will have a section on banking transition concerns. And these are kind of what we've gleaned from news reports and such that have certainly there's been a lot of interest in SOFR, the banking transition, LIBOR, and so on. So it might be a good place for people to sort of say, yeah, I feel that too. And so again, encourage some questions to bubble up. Then there's a section on tips for transitioning your institution. That's an activity. And really, the only authority is that we have here is that we have been doing it since 2018. Given who we are, we're a GSE. The FHFA has been one of the real progressive regulators out in front. So we will talk about our experience and how it can become part of your plan. And then there's some appendices at the end where it's some of the more basic information that may prove useful. And I believe a copy of this will be available after this presentation. So I'll be going through the first sections, and then we'll go through a Q&A. So let's get started here. As advertised, the first part, we're going to talk about the kind of what's been happening lately. And as I said, there has been some big news, and really the big news was started in November and ran until it was pretty much affirmed in March. So the news really was that the folks who produce LIBOR, they proposed to cease printing LIBOR in the middle of 2023, June 30th, 2023. Prior to that, what had been communicated had always been the end of 2021, the end of this year, which by the way gives rise to all the kind of the football analogies, is because 2018 was the first year where kind of SOFR entered the field. So 4 years, 4 quarters, it kind of worked out nicely. But given what's happened, there is clearly going to be an extension over time, if you would. But as we go on, we'll see that it's not exactly just you guys have 18 more months. It's a little bit more nuanced, and some of those points I think are well worth discussing. So this is just sort of the black and white facts and figures. The ICE Benchmark Administration, they are the administrators for LIBOR. So they announced their proposal to to cease the publication. That was in November. Again, this was an announcement. This had to be confirmed, and was done so in March. What's equally important is at the same time, on the same day, in the same morning, the Fed, the OCC, the FDIC, they issued a interagency guidance. It's SR 2027. And really, that's the first time where they said, we would like banks to cease entering into new LIBOR contracts as soon as practicable, and in no case after December 31st, 2021. That is very similar to our position in the Home Loan Bank in, it was September of 2019. The idea was that we were going to cease in the first quarter of 2020. That was eventually moved to the second quarter of 2020. But effectively, it's a very similar situation. And they backed it up. The Fed backed it up with some teeth. They've sort of said, they've sort of brought in safety and soundness, and then in subsequent issuance or publication, SR 21.7, they really said that this is actually going to be part of the examination framework. As I said, in March, the IBA and FCA, the IBA being the administrator of LIBOR, FCA is the regulator of LIBOR, they confirmed the June 2023 cessation date. That had the effect of setting in contracts that had been defined, because we had been anticipating this for some time, that the actual spread between LIBOR and SOFR was set in stone. So I just showed two of them there. It's set for all the tenors, but the two that I show are the two very common ones. So it's 1 month LIBOR will become, after cessation, so starting in June of 2023, will become SOFR plus about 11.5 basis points. Similarly, 3 month LIBOR, that is going to become SOFR plus 26 and a little, and just over 26 basis points. So that does lend some security or some certainty to the market. Effectively, the SOFR and the LIBOR curves are now locked together. After 2023, you actually know what their relationship is going to be. So whatever was LIBOR is going to be SOFR plus 11.5 or 26 basis points, and that's sort of this flat spread that's added. So that was something that's been anticipated for a while, and it's certainly good to know that. And it was an important and anticipated move. Moving on to slide number 6, just kind of a recap of some of the things that had happened, from the beginnings of the market to some of the important transitions that have happened, which I'll cover in a subsequent slide. But on slide 6, really, I want to bring your attention to the bottom, which is original endgame was December 31st, 2021 was end of LIBOR. So it's this year. It's like we've got we're in April, so that's eight months, which is would have been pretty daunting, and it's perhaps one of the reasons why they went this way. And that has been replaced with on the right side of this slide 6 is the LIBOR in overtime, where some of the activities we still need to look at, in particular because of the SR 2027, the admonition against new LIBOR contracts. People who are or participants utilizing LIBOR for funding, for hedging, for assets, those will largely not be available, and therefore migration, the emphasis should be on migration to alternative rates. So in terms of hedging, it would be SOFR or Fed fund OIS swaps. In terms of issuance, it would be recast or creating FRNs, which index to SOFR, for example. So those still need to happen in 2021. The relief comes from the fact that the LIBOR, as it in terms of the fallbacks and the systems, are those potentially or those are pushed back to the middle of 2023. So that allows participants to prioritize the certain things that they need to do. And in a couple slides down, when we sort of talk about the work plan, I'll touch back on that. But again, it's this 2021 has been expanded. So what was going to be done in 1 year, we're now talking about 2.5 years to get it done. So moving on to slide number 7. Yes, here's another important thing that just happened, and again, this was most betting people would have bet against it, but we're glad it's here. So early in the year, the New York legislature announced or they introduced the LIBOR legislation. This was something that had been drafted by the ARC some time ago, maybe actually not that long ago. I think it was in 2020, perhaps. But earlier in this month, in April, the Governor Cuomo signed it into law. So it is it's out there. It does. The jurisdiction is contracts that are have jurisdiction in New York State. Just a couple things to go over, just so folks understand what it is and what it isn't. And what it is, particularly to what it's intended to be, is it really has a very it's a very focused outcome, which is really there's a number of securities that are called tough legacy, and these tough legacy securities, they have a couple of characteristics. They first of all, they tend to be securities in U.S. law. If they have many investors, you need 100% of agreement from your investors before you can change things. Very difficult to accomplish that, and so that's one of the things that makes it tough legacy. The other things we list in the bullets, they're contracts that have no fallback provisions. So those tend to be older ones. There are some contracts that would use other types of LIBOR as a fallback. So other, say, tenors of LIBOR. So they might say interpolate between. Because LIBOR, the number of tenors in LIBOR has sort of been growing and shrinking over time. There's like most of us use 1 and 3 month. They're the big ones, but but there's 7 right now, and I believe there have been some others in addition that have gone away. And one of the more insidious things that some of the contracts have is that they rely on polls or surveys, inquiries for quotes. So they sort of tell the calculation agent, it's like any time that you have to fix LIBOR, if it's not on a screen, then you got to call up 3 New York banks or 3 London banks. The fact is that if once LIBOR goes away, they're not really going to be able to help you. And most of those contingencies were written because they assumed that the reason you can't get LIBOR is going to be some technical glitch. So clearly, this is a very different matter. For a lot of these, the outcome would have been that LIBOR would fix at the last print for these securities, effectively turning them into fixed rate securities, which is presumably not what folks bought into. So the legislation adds certainty of how fallback will happen. It invalidates the LIBOR as a fallback. It invalidates or makes null and void any clause that talks about polls, surveys, and such, because they're just not appropriate to the given situation. What the legislation does do is now the determining person, so the calculation agent might be the issuer, whomever is connected to that, they have the authority to utilize the recommended benchmark replacement. So this is out of the ARC is the determiner, and really what that boils down to, it becomes SOFR plus spread adjustment. Spread adjustment, as I noted, is now known, and with conforming changes. So conforming changes are things like you've got a security, it fixes in advance. Maybe you're going to go to an in arrears structure. So in other words, you know the interest rate at or close to the time of payment. So that may change it, but there are various versions of that, and there's actually a number of options that can be taken. And the idea is that these would replace LIBOR. Another important thing that the legislation offers is safe harbor. It throws in kind of all the comfort words, the words that you may see in the contracts where they sort of say, the replacement has to be commercially reasonable, comparable in methodology, or comparable in performance. And the safe harbor says it effectively declares that this solution would meet those criteria. And then it also adds that making this change would not constitute an amendment or a modification. So that brings more certainty to the situation. That is, and while that is, that this is, it's all good. It's for, it is limited to things that are securities or contracts covered under New York state law. The next logical extension is to look at it for under federal law, which would preempt the state laws. It would make things much simpler rather than having to go to multiple states, although that is something that's also happening as a fallback. So I believe it was last week there was some conversation began starting for and a discussion draft was circulated, and I believe is actually publicly available on the appropriate website. Brad Sherman is the sponsor, and it's the website of his committee. There is a discussion draft that's out there. So our hopes is that this will continue to move forward. It does cover the tough legacy, which there are not a lot of ways out of. I mean, if the contract really doesn't give anybody authority to change it, you sort of need legislation to come in and fix that. So again, this is good progress. Again, it was a bit of a surprise. Folks were not prepared or didn't give it a lot of hope. They were hoping, but it worked out well for us. Now we're just sort of the more mundane things that have happened, and mundane, not that they're not important, but it's just that these things were on the plan. So these were predicted, and these were things, that initiatives that we wanted to happen, the ARC wanted to happen. The first two have to do with Fannie and Freddie, obviously big players in the market in a number of ways. They have introduced SOFR as both on the CMO side, on the bond side, as well as in the eligible loans. So and they have pretty much shut down LIBOR, both in terms of acquiring loans. I believe that the CMBS for, I forgot which one. One of the two sunsets shortly, but that's not has not been completed yet. But for pretty much for all the other products, LIBOR is no longer eligible for purchase, and in addition, it is no longer issued as a bond. So they began issuance of SOFR CMOs in July of of last year, and so it's these are important just as because they're large players in the market. It's also important because this is the kind of the first case of loans using SOFR. The loan market has been a little bit slow to bring on SOFR. So SOFR in the mortgage markets and ARMs and hybrid ARMs is a big step. And in fact, our bank, we are taking some of that collateral today. I don't recall the exact numbers, but it was, it was not an insignificant amount. So that's definitely happening now due to their work. In October, there was a fairly high-profile conversion, both clearinghouses for derivatives. They switched over from Fed funds discounting to SOFR discounting of all swaps, regardless of the index type use. So this applies to LIBOR as well as SOFR and Fed fund swaps, and it's used. So now it's used for the cash it's used for the cash collateral that goes back and forth. As part of this process, the CME and LCH both created compensating cash swap transactions. So they would be SOFR Fed fund basis swaps, and so that those became part of the package. That the combination of that plus the original swaps gives you exactly the same exposure in terms of rates and basis between the rates, and so that was successful. That happened in the middle of October, and then very shortly thereafter, ISDA finally published their amended ISDA definitions. This was actually a huge step because this had been anticipated for a long time. It defined how LIBOR swaps are going to transform into SOFR swaps. And it allows people to contractually agree to that, to those changes. And I just went there last week for this report to update it, and was surprised or pleased to see there's 13,000 adherents as of April. So we were there. We signed it that week in October, and at that time there was maybe 250 adherents, and it's just been continuing to trickle in. Bloomberg had been hired on to publish their spread adjustment. Again, that spread adjustment tells you that SOFR LIBOR will be replaced by SOFR plus a spread adjustment. And Bloomberg was hired to do that. It's somewhat moot by this time because now it's fixed. So there's no real need to keep looking at that market. Okay, now here's the one thing, moving on to slide 9, one thing that hasn't happened that we had anticipated was the idea of a forward-looking term SOFR index. So this would be something where you could say today, I have a forward-looking SOFR index that's going to take me a month forward, because pretty much everything out there now is in arrears. So it's sort of at the end of the accrual period. That's when you say this is what SOFR did, and that's what the rate will be. Forward-looking was to be more similar in a way to LIBOR or Treasury or other rates that are used in a term sense. So that was originally planned for 2021. There was one point where we thought it could happen by, I'm sorry, and I say we, I mean the ARC, the Federal Home Loan Bank is a member of the ARC. So there was one time where 2021, the second quarter was targeted. In March, ARC did publish that they said, we don't think we can get there. This was really reliant on the derivatives markets being more liquid to be able to facilitate that, and it's just not there at this time. and potentially may not be there by 2021. I think, and one of the messages there was, guys, don't hold on, don't wait for this, don't make this kind of central in your strategy. Look for other alternatives. And just yesterday or 2 days ago, they published term SOFR principles. One of the things just to know is ARC is concerned about the idea that creating a forward-looking term could get you back into kind of into the LIBOR situation, the inverted pyramid. Like if they publish the forward-looking term, let's say the swap markets adopted that. I mean, that's sort of the scenario they don't want to happen. And then the overnight swap, the OIS market, kind of could potentially wither away. This forward-looking becomes more dominant. And then the idea is now you're sort of disconnected because the existing OIS market is connected to $1 trillion of real transactions. And that's always been the emphasis for all of these LIBOR strategies, to sort of make sure you stick it to real life transactions. So they're in a interesting situation, but that's really the purpose of this, is just to sort of say, we don't want this to be used everywhere. There's a use for it, presumably in cash markets, some cash markets, possibly loan markets, certainly in cash markets like the floating rate notes that the Home Loan Bank uses. We found a great success with a backwards looking daily accruing rate that's worked out just fine. It seems to work out fine in the derivatives market. But again, the ARC is acknowledging there's some corners that just need, or they've expressed a need for that. And so I think they're playing a balancing act. They want to accommodate, they want to define some guardrails around it. So that's what that means. All right, so we'll talk a couple of slides. These will be fast on SOFR market growth 2018 to 2021. This is floating rate note issuance. This was sort of the big success story fairly early on. There was a lot of robust issuance. For a while, it was bigger than the derivatives market, which is a little unusual. The note really, okay, when you look at this picture, you see some spikes and dips. Here's what you really want to look at, is that the GSEs, and in this picture they're blue, they dominated the market for the first two or so years of SOFR FRN issuance. What you'll notice in the last 6 months or so, you'll see that banks have taken over. They have kind of reached parity toward the fourth quarter, and are now very much ahead of the GSEs. I think I showed that in a different way here, slide number 12. This is as of the end of March. It's kind of almost thirds right here. You've got Home Loan Bank with almost a third of all issuance that have happened since we started in 2018. The other GSEs, so it's Fannie, Freddie, Farmer Mac, the other government-sponsored enterprises, it makes up about a third. And then banks and corporates, which make up the last third. The banks and corporates are slightly larger than the others, and this is from the beginning of time. But when we look at the last 6 months or so, banks and corporates are 63% of SOFR FRN issuance. So we see that as a good sign. It's the home loan banks and the GSEs. They were there when we needed to be to help sponsor that market. But now there's an organic uptake from the banking business. So I think that's a good sign. Moving on to slide 13, it's a similar type of picture for SOFR derivatives. The real thing to note is the volumes have just really popped after in October and following. So October was when the big bang, the discounting change happened. LCH and CME are the two big clearinghouses for swaps. They switched over to SOFR discounting, in effect making every derivatives user now has a SOFR, has sort of a, has a skin in the SOFR game, as it were. So you'll see it's pretty much doubled as soon as that happened, and it's kind of continuing to head up. And what's less notable but important is you will see the dark red sort of near the top in the last 6. Those showing SOFR swaption transactions, swaptions and cancelable swaps, not particularly big, but they're important. That was one of the latter things that had not been developed in 2018 or 2019. It sort of started in 2020, and these are SOFR derivatives that have optionality. So that's the kind of the other dimension of the swaps market. So that is that's out there, and it is something that we are using. I think all the home loan banks are users of that. So very happy to see that, because that was not on anybody's plan. They figured it would happen organically, and we're just happy to see that it's starting to do so. Okay, moving on to slide number 15. This section has to do with general banking concerns. So again, this is a little bit, these are sort of opinions. These are based on what we've seen in the literature, and perhaps from some questions, and you may have some questions following this as well. This is sort of we've deviated because it's not about the home loan bank anymore. So it's really, and then that's what the disclaimer's for. So it's informational purpose. We don't have any connection to any of the issuers that we'll see a little bit later, or index vendors, I should say. And we'll also state that the reality is that SOFR is it's been very effective for us. The market is growing, but there's no guarantee of where that's going to go. We do know that it's here today. It certainly meets our needs. It's been it's been a good substitute, and it's important and critical as a fallback mechanism. But in terms of the new transactions, it's a big picture. So there are 4 questions here. I'll go to the next slide just to make it easier. It's slide 16, where it kind of asks the question and addresses it. So, is SOFR the one alternative index? And I guess that depends on who you're asking. From the ARC's position, it is the one that they endorse, for sure. It's the one that they endorse particularly for fallbacks, and that was a very big consideration fairly early on. That being said, it's voluntary. The ARC is not forcing anybody, and neither, to the best of my knowledge, are any of the official sector forcing anybody into this direction. Probably the strongest use of SOFR, or the strongest kind of requirement, is when it comes to fallbacks. I mean, it's definitely, it's named, it is the fallback. It is the ARC recommended fallback for non-derivatives, for cash product. So there it's listed. It's in the New York legislation, for example. It is listed there. And one thing to consider is that I think most people from the ARC to any of the official sector, they're very open to what's out there. But the thing that makes SOFR different, and it's by construction. SOFR was the only market where you actually had $1 trillion of activity, $1 trillion days. So that's actually been the average from 2020 to today. And the leanest days have been 800 billion. Sorry about that. I'll fix that. $800 billion has been the minimum days, and really there is no other market that approaches this depth of activity. And we'll see a couple of other examples, and we'll be able to compare between them. Goals of the legislation. Again, it's really, I think, for almost everything I've seen, it's been, it hasn't been to try to force one thing over another. It's really looking at the small segment of contracts where there's no alternative, and it's really trying to address that. The next one is we're sort of increasingly getting into opinions. So can banks use a secured rate? And I throw in two examples, and they don't directly answer the question, but they just sort of make the point, which is, or make a point. So if we look at the alternatives, first one, just let's look at LIBOR itself. How did LIBOR perform a year ago when the COVID first started happening? And you'll see that liquidity just kind of dried up. I mean, there's a publication of how much is based on how many fixings are based on transactions, and that really dwindled down to a very small number in March of 2020. And then the second point is, and I'm not picking on Ameribor, but just a market observation of comparing Ameribor to, say, Fed funds. If you look at their long-term average, it's say 10 to 11 basis points. And it did peak in March. It did widen, but it was something like 12.4. And I guess I'll leave it to folks to say, is that commensurate with what happened? LIBOR certainly widened quite a bit more than that. So again, I apologize. Not going to be able to answer the question. Just putting out. I think if we do answer the question, we wanted to have it based on facts and figures. The last one actually is a little less opinion. It's is an overnight operationally viable? Clearly, in one sense, it's provably viable certainly for certain markets, for securities, for derivatives, for swaps. One thing is that, as we noted before, the ARC did signal that the SOFR term rate recommendation, it was just not going to be imminent. They weren't ready to do that. So that was one of the potential ways to get away from using an overnight rate. Last year, the Fed started publishing 30, 90, 180 cumulative average SOFR rates. Now, those can be used in a number of ways. They can make calculation much easier. There's sort of one place to grab those numbers. So I think that was a big move forward with regard to the operational considerations. They are Freddie and Fannie, in fact, have run with this idea, and they've actually taken it a step further. They are using these rates. So a rate for today, the 22nd, that would cover the last, say, 30 days of SOFR, compounded from a month ago, 30 days to today. And what Fannie and Freddie have done is that they've taken that rate and they said, we're going to use this for the next 30 days. So they've introduced a lag, but you now know what your next coupon is going to be. You can actually accrue every day to get there. It fits in from the system's perspective quite nicely, and they seem to be finding some success with that. And last is that we do have this 18-month extension, so that there's the hope that, or certainly there's the prospect that operational and technology issues can be eased by this move. Slide 17. Yes, this is one that I was just putting together at the last minute, it's to show that there is work. There's work in the private sector. Different people are coming up with things that are closer to the user. They seem a lot closer to LIBOR. They have a credit, they have a term. In some cases, they kind of capture the range of the same term as LIBOR. I put these three up here. They're the three that seems to be getting the most press, seem to be the most viable. They're each backed by vendors who have sort of a proprietary stake in one or another part of that market. So clearly on the all the way on the right side, you see ICE is in there. So they're the LIBOR vendor. So they're actually using the panel banks and extending that methodology. Bloomberg in the middle, they've created the BSBY Bank Short-Term Yield Index that can leverage their trading platforms. They have access to a lot of proprietary data, and they base that on that. The Ameribor, they run an exchange, so they have an overnight exchange. It's I think they're branching out into a term lending, but they're bringing in other forms of data to make it into a more robust rate. 30-day is out there now, and they're looking at other tenors. Now, the one thing that I did want to talk about real quickly that I mentioned before was the trade volume. So at the bottom, second to bottom line, you'll see that they sort of note some in their rules what the trade reference volume is. Typically, they can't get that volume from a single day. They have to capture kind of a rolling multiple day look back. So 5 days is Ameribor. Bloomberg's got 3 days. They have mechanisms to extend those as needed to meet those thresholds. So they're certainly very committed to the idea of using transactions. The challenge is that transactions can be hard to come by, particularly and ironically in a credit situation. The credit index often just does not have the prints, the business to use for that for those circumstances. And I think the thing to contrast is you've got numbers from $10 billion or $9 billion up to $60 billion, and that contrasts against $1 trillion for the SOFR, for the transactions underlying SOFR. So. So I think it's getting there, but you can sort of see there's a big difference in some ways. And again, disclaimer is, we don't represent or, this does not imply any endorsement. It's informational. It's just letting you know what's out there at this time. Okay, I'm going to go do this real fast. I know I've taken up a lot of time. Transition checklist. These are some of the things that they're in the Fed guidance, things that have to happen. This came from the ARC originally, and it really starts off with make sure you have somebody who's in charge of it, that it's the kind of the full-time job of a person. Make sure you've got the communication strategy, you're measuring your exposure, you're looking at your contracts in terms of the things that need remediation, that you've got risk management involved, accounting is involved, your financial reporting has to be in there, and operational technology readiness, big part of this is systems, because things like SOFR are quite different. Fly through this. This actually, this will be my last slide before I cut over to Tom. The way we've looked at this, and we believe we found some success here, is to break up the whole world of activity into really three things. It's legacy LIBOR, successor SOFR, and process migration. Legacy LIBOR, obviously, it's what you have on the books. What's going to happen to them? And we break that up into two parts. One is making sure you've got a fallback plan for how that's going to happen. And that, in turn, has two parts, one of which is the lawyers, bring in your counterparties, make sure folks understand and agree to however that's going to change. That starts with an inventory, actually. That's the very first step of what these things are. And then the other piece is being able to model and run those things. Similarly, understanding what your existing exposure is critical. That starts off with an inventory, because sometimes these are in different places and really you want to net them all together. Successor SOFR, and again, Successor SOFR is probably the emphasis for this year, which is really, if the end of the year means no more LIBOR, you want to make sure all the things I use LIBOR for, I can do today. And the good news is that the markets are out there. And Home Loan Bank's been doing this for at least two years, and I would say kind of fairly completely in the last year or so. Process migration is the other piece. It's not strictly connected to transactions. It's really connected to things like, I use my LIBOR curve for pricing. I use it for for calculating risk. That clearly has to migrate to an alternative, the SOFR curves. Much of that is available today. The volatility piece is just sort of coming into place now. It's for many folks, it has to be, a lot of this is interacting with your vendors, having that relationship and having the discussion. So legacy LIBOR, successor SOFR, process migration. We just think that it makes the conversation a little bit easier when you can sort of slot things into one of those objectives. I'm going to skip this. Okay, I'm on slide 22. SOFR products. So this is the where Home Loan Bank can help you. So Tom, this is your cue. So I'll let you at it. Mr. Settino, are you on? While Tom gets on, I'll just start off by saying, our first product was the SOFR ARC that we did in.
Am I on, Ray?
Now you're on.
Sorry about that. Just experiencing technical difficulties. All right. Yep. Well, thanks, Ray. I appreciate all the great information. So I just wanted to quickly, I know we're running long on time. I just wanted to highlight some of the SOFR products, some of the products that we developed at the Home Loan Bank of New York in response to LIBOR cessation or LIBOR transition. So let's start off with the SOFR ARC. So the ARC stands for adjustable rate credit. That is another terminology. It's for floaters. So we have our SOFR floaters or SOFR ARCs. So we rolled that out in the end of 2018, at roughly around the time or very close to the time when the Home Loan Bank started to issue SOFR-based debt. So we have two kinds. We have a SOFR ARC that's a simple average, and then we also have a compounding SOFR ARC. Pretty much very similar products. Both have 3-month minimum terms. The compounding SOFR ARC has a 5 million minimum term, but they reset daily. So why would a member want to engage in a SOFR ARC? So if you have SOFR-based assets, as they become more popular, I realize that a lot of financial institutions don't have much in the way of SOFR assets, but they could match fund that closely and reduce basis risk by having a liability of the same index as the underlying asset that you're funding. Also, asset-sensitive institutions can utilize floating rate funding, and they could add term funding onto their balance sheet to help with their liquidity metrics. But then they could hedge from a static and declining rate environment. Should rates remain static or decline, they could benefit from the low initial cost of the advance, and then they could ride down the curve should rates decline. And that's versus regular fixed rate long-term funding. If you're asset sensitive institution, most likely you'll be funding more on the shorter side. So this is a good product for that. You could also combine this SOFR funding with a SOFR swap. A lot of our members utilize floating rate advances, and then they link them up with interest rate swaps. So if you could choose a structure where you could achieve significant savings versus a regular fixed rate bullet advance. So you could choose a SOFR floater and then link it up with a long-term swap, and then achieve some financial savings. One thing to note, we are working, and in the past we used to have caps and floors that we could embed into our floating rate advances. We are working on that, and we hope that's forthcoming as the derivative markets evolve surrounding SOFR. But that's also helpful. You could have low cost funding, and you could have a high cap in there. When you're doing your regulatory shocks, the cap kicks in and then helps you out with your economic value of equity metrics. So moving on to our next product, something we rolled out around a year ago or a year and a half ago, the SOFR callable ARC. So we have two structures. One is a short-term structure where when the advance hits 1 month left to maturity or 30 days left to maturity, the institution has a euro or one-time call. So as that funding gets shorter and shorter and it hits the 30 days left to maturity, the institution will have a decision to make whether they don't need the funding. Say if their balance sheet changes, they no longer need the funding, they could extinguish and achieve savings. Or if you don't need, if you need funding or liquidity of a larger or longer term, you could extinguish that at no cost. The callable is a product where you could extinguish at no cost, and then you could rebook an advance or a longer term floater and extend your liquidity. So it helps you with your liquidity metrics, but also can help with a fluctuating balance sheet and help you achieve savings. And then our next callable product is a term callable product. That we only have one structure for that product, but that is designed for you to manage your term liquidity. So we have a 3-year product, a 3-year SOFR floater, but with a call when it gets 1 year left to maturity. So it's a 3-year non-call 2-year. And there's a euro call, one-time call, but if you're trying to keep or maintain liquidity out beyond the 1 year left to maturity point, this is a product that could help you do that. So, and you don't have to have liquidity you don't need with a maturity below 1 year if you're managing your liquidity metrics to that standard of having long-term liquidity. And then lastly, we do swaps with our members, and we do SOFR swaps with our members. We do these directly with our members, so they're not an exchange traded swap, but there was a carve out in Dodd-Frank that allowed financial institutions with an asset size of $10 billion or less to do direct swaps with their financial cooperative. So it's a carve out for the home loan bank. But we do swaps. There are advantages of doing SOFR swaps with us. One of the primary advantages is that we're a AAA rated counterparty. Counterparty risk is a serious concern when engaging in a swap, and we are a AAA rated counterparty. So that's one of our strengths. Also, your market position associated with your derivative or interest rate swap will always have to be collateralized with securities, oftentimes with cash. So when you engage in interest rate swaps with a home loan bank, it encumbers your whole loan mortgage collateral. So you could use your whole loan mortgage collateral as a collateralization means for your outstanding interest rate swaps. And that happens automatically. There's operational ease. You don't have margin calls associated with an arrangement with us. One thing to note, though, we do not provide the full package. Some firms provide accounting advice associated with their derivative transactions. We don't have that feature. And also, collateralization posting is unilateral. So we don't post collateral for out of the market positions that we have with our members. But if the member has the out of market position, we will encumber their collateral. So with that, Ray, that's all I have to say. We do have a question or two that came through. One is, and I think you addressed it. Well, no, this one maybe you did not address. So the question surrounds when they want to roll out a calculation date and roll that out to their customers. Right now, the cessation date is June of 2023. Is a bank prohibited from switching over their customers at an earlier date? So if a bank chooses a specific date of like March 31st, 2023 to calculate the conversion, is that fine for them to do, or should they wait till the June of 2023 date?
No, yeah, there's no prohibition of early conversion for pretty much for any party. And in fact, it's considered that it reduces the systemic risk if folks are doing these conversions, at their own pace, and to right, because there's some people with consumer loans, there could be thousands of these things. So yeah, there's some plan to do that in a systemic way and not not have them fall back, because some people have said the way they think about it is a fallback it's a great thing, but it's like the airbag in your car. It's like you don't want to have to use it, right? You'd rather steer around the tree than to depend on it. So yeah, so I think the answer is yes, you should feel free to and are encouraged to to move forward as kind of quickly as both you and the counterparty are ready to do so.
Okay, and then the last question, Ray. We're pretty much run out of time, but what about the timing of embedding caps and floors into our ARC advance? Is that something that's in the near term, or did you envision that to be a 2022 event?
I would say it's almost the you pick the it's almost a 50-50 kind of thing. I mean, we sort of are thinking that maybe the last quarter we may have some market coalescing around caps and floors for SOFR, because it's the overnight index makes it a little bit more complicated when you have the coupon payment. How do you calculate the mark to market on that? That's it's also exacerbated a little bit by the fact that in the old days you would have agencies and they would have a LIBOR, 1 month LIBOR, and they would have caps, right? That would be that was built into all CMOs is that they would be capped, and then cap market is always out there because they say, well, I'll uncap you. You buy a cap from me, and then you uncap your exposure. One of the challenges is that Fannie and Freddie, they are, they're not using SOFR in arrears. They're using that SOFR average that they're applying for an in advance use, and so there's been some usage of cap. Investors are interested in that type of cap, which works well for that providing a solution, but may not be general purpose because it sort of embeds in a delay of a month for a 1 month cap. So we don't yet have a lot of, or at least to my knowledge, we don't yet have a strong replacement for the LIBOR caps and LIBOR floors. Clearly there's a need for these products. It is probably the last part of the market or last part of the standard market to come into play. As I mentioned, swaptions and cancellables, they did sort of finally, they began to take presence in February or so of last year, and by the fourth quarter, they were trading robustly enough that we began to do some sizable business or sizable work converting our existing LIBOR cancelable swaps into SOFR. So that's something we just have to keep our eye on, and 50-50 end of this year, beginning of next year, I would say, yeah, that feels about right. I don't know what I'm basing it on exactly, but it's not going to be tomorrow, unfortunately. But certainly, as that's there, we want to be on top of that. I mean, our goal is to replace, insofar as it's possible, replace every single product that we have ever had, that customers want, that members want, that they're looking for, to replace those as soon as we are able to. And I think we're making decent progress.
Okay, thanks, Ray. Yeah, no, of course. So the relationship managers will be keeping the membership apprised of all those developments on an ongoing basis. But thanks, Ray. Really appreciate all the valuable information today. I hope everyone enjoyed the presentation. We thank you for your attendance. One last reminder, Adam Goldstein had mentioned it earlier. Our next webinar will be on May 13th, Thursday, same time, 11 a.m. And it's regarding the evolution of payments and payment systems. And that'll be presented by thought leaders from Bank of New York Mellon. So with that, thanks, Ray, and thank you, everybody, and have a wonderful day.
Thanks, everybody. It's been a pleasure.